Dividend investing or dividend growth investing is, I'm sure, a term that you've come across here on YouTube or in the investing community in general. It's a very powerful strategy if used correctly, and what I want to do today in this video is teach you guys just how I look for dividend growth stocks, what kind of metrics to look for if you want to actually hold these for the long term, and how certain things like the current dividend yield may not be the best thing to look at when looking at these stocks for the long term. There's a few gotchas here and there, but I'm going to go through a working example with you guys. We're going to compare two stocks side by side, both growing their dividends, but there is going to be some differences which kind of hint as to which will be the better dividend growth stock for the longer term. So if you appreciate this video, want to see more dividend type videos on this channel, don't forget to subscribe, hit that bell notification, and drop a huge like down below, because the more likes I get on these videos, the more it tells me that you guys enjoy these videos, and then as a result, I'm going to create more videos just like this. Okay, so dividend growth stocks are dividend stocks that not only pay out a dividend, but they continuously grow their dividend year over year. Some of the most well-known dividend stocks are known as Dividend Aristocrats. I'm sure you've heard that before. Or sometimes the ones that pay out, I think, over 50 years or more are known as Dividend Kings. So these are stocks that are well recognized as dividend payers, dividend growth payers, and they're part of this very prestigious club that certain investors look for specifically to invest in. But here's the interesting thing. When looking at these Dividend Aristocrats, although they are stable companies you can own pretty much forever, a lot of them aren't the best companies if you're building a dividend growth portfolio. And the reason is simple. It's because their dividend growth rate is much lower than what you'd actually want to have in your portfolio if you plan to keep the stock for the long term. Now, if I am losing you here, if I am confusing you, just hold on for a second. We're going to go through a working example, like I said, and this will make everything clear as mud, and you guys will understand the power of dividend investing. So here on the screen, I have Johnson & Johnson, ticker symbol J&J, which is one of the most popular dividend stocks here out in the community. Now, from the information I have on the screen here, you can see that there are three key facts. The first is that they currently have a yield of 2.89%. That means if you buy the stock right now, say you put $100 in Johnson & Johnson, you'd get $2.89 per year back in dividends. Next, we have the payout ratio, and this tells us how sustainable the dividends that Johnson & Johnson is paying out is. Usually I like to look for a number less than 70%, ideally a number less than 50%, as that shows the dividend is sustainable and they will most likely continue raising this dividend in the upcoming future. Finally, on the far right, we have the growth years, and this pretty much shows us how many consecutive years, in this case Johnson & Johnson, has raised their dividend, whether that's a 1% raise or a 10% raise. Nonetheless, it's a raise year over year. Now, jumping to the next screenshot here, this is where we need to pay close attention. You can see that we have the 3, 5, and 10-year CAGR, which stands for Compound Annual Growth Rate. Now, the CAGR percentage actually tells us the growth rate of the dividends over that respective time period. And this is a very important metric to understand and make note of when looking at any dividend growth stock. Now notice, even though Johnson & Johnson has been raising their dividends for 57 years, which is an impressive amount of time, it grows its dividend annually around 6 to 7% per year. So that's not bad, but we still don't have any context here as to what maybe another company would be growing their dividend at. So let's put Johnson & Johnson aside for a minute and look at another dividend growth stock here. In this example, we're going to look at Lowe's. So once again, we start off by looking at the starting yield. In this case, it's 2.06%, which is actually lower than Johnson & Johnson. But then we see their payout ratio is actually very low, which means that this dividend is very sustainable in Lowe's. And finally, we can see that they've been raising their dividend for 55 consecutive years. Many of you probably don't even know that Lowe's has been around for that long, but nonetheless, they have been raising the dividend for that long. Now, looking at their CAGR, you can see the numbers here are much higher than they were in Johnson & Johnson. The average for Lowe's is actually sitting between 18% to 21% year over year, compared to Johnson & Johnson's growth of 6 to 7% year over year. So although at first glance Johnson & Johnson seems like the better option because it has a higher starting yield, Lowe's is actually the better grower here, and over time, over the long term, this will actually make a huge difference. Now, what I want to do to kind of drill this point down even more is to show you guys with a hypothetical $10,000 investment how this makes such a huge difference, and whether you put that $10,000 in Johnson & Johnson or you put that $10,000 in Lowe's. But before we do that, I'm going to make 4 main assumptions here, okay? So the first assumption will be that the CAGR, the compounded annual growth rate, is going to be consistent indefinitely. So this is not 100% realistic. It will fluctuate over time. But for the sake of this scenario, for the sake of this hypothetical example, we're going to keep that rate consistent. The second assumption is that I'm actually going to take the lowest out of the three options that we had. So we had the 3-year, 5-year, and 10-year CAGRs. I'm going to actually pick whichever one of those three is the lowest percentage. The third assumption, of course, is neither of these companies will cut their dividends. And the fourth assumption, of course, is that I'm not going to take into account any capital appreciation here. Of course, over the long term, we do expect that these stocks will be worth dollar value much more in the future than they are now, but that's not going to be part of this calculation here. So here on the screen now, we understand our assumptions. We have Johnson & Johnson on the left, Lowe's on the right. Now I entered the value we saw earlier for their dividends, and you can see that for Johnson & Johnson, I used 6.27% CAGR, and for Lowe's, I used 18.36%. Johnson & Johnson has a higher starting yield, but Lowe's has a higher growth rate. So now with a hypothetical $10,000 investment, in year one, Johnson & Johnson is clearly the winner, earning me $270 in dividends versus Lowe's $187 in dividends. Now this is quite a significant difference, and this is because the starting yield of Johnson & Johnson, like I said, is much higher to start off with than Lowe's. Now let's fast forward on to year 3. Johnson & Johnson is still better, giving us $324 in dividends per year, whereas Lowe's is giving us now $310 per year. You'll notice that the gap is closed off significantly here compared to year 1, and this is just in a span of 3 years. This is again because Lowe's is growing their dividend much quicker than Johnson & Johnson is. Now moving on to year 5, Johnson & Johnson earns us around $366 per year. Lowe's now earns us $435 per year. So now Lowe's is actually paying us significantly more than Johnson & Johnson in just 5 years. And this trend really continues, and after 30 years, you can see Johnson & Johnson pulls in a measly $1,675 per year from our initial $10,000 investment. But Lowe's, if everything stayed consistent, would be giving us $29,433 per year from dividends from that initial $10,000 investment. And this can really be visualized by this graph here. You can see just how quickly this acceleration in Lowe's picks up, and it truly shows you the power of a strong dividend growth stock here. Now, like I said, I made the assumption that the CAGR will continue indefinitely, but in reality, that'll most likely slow down as Lowe's gets larger. Maybe in 15 to 20 years, they will be at a 10% growth rate, but it'll still be earning us more, in my opinion, than Johnson & Johnson, even if the growth rate does decelerate. But again, remember, this is all a hypothetical example to show you the true power of dividend growth investing. So in summary here, after looking at this example, I hope it really opens up your mind and kind of shows you the most important thing, which is to not just look at a starting yield. Now, there are certain situations where a high starting yield is important. Maybe it's for a short-term investment, maybe for 3 to 5 years. You want to park your money into a stock or some sort of vehicle that pays you a high dividend. Then in that case, you're not really planning to hold it over, say, 10, 20, 30 years. So that growth rate doesn't matter as much to you. But if you're looking for a longer term investment, say you want to put this into your retirement account, you want to hold this for 20, 30 plus years, then you want to look for stocks that grow their dividends ideally in the double digits year over year and have a good history of raising those dividends over time, even during tough economic times. Also, another huge thing that we didn't really account for in this calculation is reinvesting those dividends. So if you were to reinvest those dividends, you'd come out with a lot more money than we actually calculated here in this hypothetical example. That's just another layer of compounding that kind of works in your favor, especially if you have a longer time horizon. So I hope this video was valuable to you. It was really interesting for me to make this. It's not something I've covered on this channel before, and it's something that I'm personally looking more into because it is a strategy that I do enjoy. It is a strategy that I do see a lot of value in, and it is a strategy that I'm kind of deploying personally in my portfolio. I think that if I start now when I'm younger, I'm going to have plenty of years for this compounding to work in my favor, have all these great companies paying me all these dividends, reinvest those dividends, and then eventually live off those dividends. Now, this does not mean that I'm going to be dedicating 100% of my portfolio to these dividend stocks or dividend growth stocks. I will still have growth stocks in my portfolio because I do believe that having a balance of both is going to be the best investment option for me moving forward. But either way, enough about me. I hope you guys enjoyed this video. If you did, make sure to drop a huge like down below and subscribe as well to join the community. Hit that bell notification so you can see more videos like this when I do release them. So let me know in the comment section down below if there's any more requests you guys have. But either way, guys, thank you so much for watching. Thank you for the support. Don't forget to invest positively, and I'll see you in the next one. Peace.